you are to cut. Okay, so if the cost of the items that was sold was 24, have not started the question. I just started with the profit before tax, which is a 403, and then have added my entry. So next to add the depreciation. So we said on depreciation there's a opening and closing. So opening was 2018, closing was 2416, but then that information is not enough to cover our depreciation information. So which means we're going back to read to the adjustment. So on the adjustment, they're saying equipment that had cost the company 240,000 was sold in February for a loss of 12,000, the net book value of the company. So since there's a loss also, and the loss or profit is required here, we're going to bring it as well. So remember, I'm writing this with respect to 3 zeros on top. So there's depreciation, we'll come back to that. There's a loss of 12,000. If it was a profit, you're supposed to put it in bracket because money is coming. Okay. Then since it's a loss, it will be outside like that. Then for depreciation, they said asset that was costing the company 240 was sold for a loss of 12,000. The net book value of the equipment was 96. So for each to reach at the net book value of 96, which means it lost value, and the loss of value of a fixed asset is a depreciation itself. That's what we call depreciation. So it costed the company 240,000, which is a 240, but the net book value was 96, which means the 240 minus 96, which means the depreciation was 144. So the 144 is the depreciation of the asset which was sold, which means this figure is not in the closing depreciation. So in our closing in this case was the closing dip was 2416. So we're going to add this figure that we have plus the 2416. We have that figure there, then minus the 2018, which is opening. So we have the depreciation of 542. Depreciation of 542. Okay, so that's all that we need here. If there's any short-term investment, long non-current asset investment that was sold, we are seeing its value here but it's not appearing anywhere here, or let me say its value is appearing on the opening at the end, it is not there, that figure we needed to handle it as well. But in the case we don't have any other non-current assets that were sold, so this information is enough in our case. So we have a 542 plus a 12 plus a 65 plus a 403. So this is a 1022. Then on working capital changes, we have 6 things that I've always found there. Okay, so on working capital changes, I said we have 6 things that I found there in every question. In some questions, yes, you may not be able to find things like what's this dividend. Sorry, you may not be able to find dividends, but you can still write it and indicate it as 0, so much that it will be giving you a mark that I'm supposed to have 6 things here. So if you find yourself having 2, 3 things, know that you've forgotten the other 3. Yes, so working capital changes, we have 6 things there. First of all, there's an increase in inventory. That is if it is increasing. So in our case, our inventory was 321, at the end is 387, which means it has increased. So increase in inventory, it was 38, closing minus opening, 387 minus 321, we have 66. So inventory is amount of money that is available in the shop, that is in the goods that are not sold. Let me say this is stock, the goods that are not yet sold in the business. So if the inventory was 321 at start, at the end it is 387, which means they went to buy more inventory, which means cash went out. That is an outflow. No wonder I've put it in brackets. Then coming next to have increase in receivables as well. Receivables are debtors. Debtors are people that are owing the business. Increase in receivables or debtors. So debtors, if they're increasing, which means people that were owing you money, people that borrowed from you were 20. If tomorrow they are 40, which means another 20 came to borrow, which means your money has gone outside. So if the figure increases, which means it's an outflow, cash has gone out. So if at all, at start we had 607, at the end you have 754, which means we have 147 more people that came to borrow, money went out. It will be an outflow like that. Then next, the increase in payables, amount of money that the business is owing. Increase in payables payables, we had at the start 387 minus 438, so we have 51. Payables, we are owing 387, started and you're owing 438, which means we went to borrow more money. That money is not ours, so which means that money came, it's an inflow, no wonder it is outside. Then I said there are 6 things there, so we're still remaining with 3 things more. Then here we have interest paid. You can even write them in advance. In every question they are there. Interest paid. Then we have dividends. We have tax paid. Then we have dividends. Okay, so on interest paid, in every question you're going to find under the adjustment, you're going to find opening and closing interest. In our case, there's accrued interest owing. So the opening was 9, the closing was 15, and in the income statement you have interest that has been mentioned. Remember, I said we are not using anything from the previous year. We're just interested in the current year or the closer year. Okay, so for the interest, you can just draw up a simple table to help you. So the opening interest, in our case, the opening interest was 9. Since interest is a liability, it has a credit balance, it is 9, you write it there. And then the closing was 15. The closing, well, that is balance brought down, balance carried down is 15. And then the interest that was paid during the year, which means this interest, where is it? There's interest payable, which is 65, which means they paid this 65, which means money went outside. So okay, sorry, so we're going to add this 65 to the opening. So the 9 plus 65 is giving us a total of 74 on each. 74 even here. The 74,000 figure that we have, we're going to subtract the 15, which means the interest itself is a 59. Interest is a 59, which means we can call it, this is the difference, 59. You can call it income statement, which means if at start they had a balance of 9, at the end they have a balance of 15, and during the year they incurred a 65, which simply means the total was supposed to be 74. But how come at the end they're arriving with the 15? Can't she? There's a 59 which they paid, and that's why the thing that we're interested in. So that is the 59 that we have transferred that side. Same applies to tax. You can draw the same simple table. For tax. So opening tax, in our case, our tax is current tax payable. So our opening was 66. Opening was 66. Opening was 66 and closing was 102. 102. And during the year, there's a tax of 97. So it will still come here as well. 97. So if you add the 66 plus 97, we have 163, which means the totals here 163. But how are they arriving at 102? So we're going to subtract the 102, which means there's a 61 tax that they paid. There's a 61,000 which they paid on the tax. So the 61 is what we're going to bring here as our income statement, which is what we're going to transfer here. 61,000. All these are subtracted. Money was going outside. Then next, dividends. So for dividends, we're going to start with the opening retained earning. So in our case, our open retained earnings was 441. Then we are going to add the profit for the year. So the profit for the year was 30. The profit for the year was 306. 306. So we have the total of 747. Then we are going to subtract the closing retained earnings. So we use the opening, so we're going to subtract the closing, which is a 702. So our interest is 45. Our dividends. So I said we're going to get open retained earning plus profit for the year, then minus closing retained earning. The difference that we're going to get, that is our dividends. That's all. We don't need anything else. So the 6 things here are done. So if at all dividend was not there, we're going to get this figure as a 0, which means okay, let me say in some questions the dividend is given, which means you're just going to get the figure directly. That was supposed to be mentioned under the adjustment. Dividends was 45,000, but in our case we're supposed to calculate it. So if we calculate opening retained earning plus profit for the year less closing retained earning, that's all. Okay, so we had the 1022 on top, positive, minus 66, the bracket means subtract, minus 147 plus 51 minus 59 minus 59 minus 61 minus 45. We have 695. We have 695. So that's all with our operating activities. So that is our cash flow. Cash operating activities. Okay, then we go to our investment activities. Under investment activities, we're interested in the things to do with what is happening to our non-current assets. How much did we buy them? How much did we dispose? How much did we sell them? Was there any profit or not? Those are the things that we're interested here. Remember the profit and loss we dealt it with here, but now here we're talking about how much did we buy them? How much did we sell them? That's all. So first of all, we're going to start with the acquisition or purchases of non-current assets. So purchase of non-current assets. So for purchase of non-current assets, it's a direct thing, which means you are supposed to get the opening plant and equipment at cost. The opening is 4777 minus the closing, which is that. But then there are some items which were sold during the year. There are some items which were sold during the year, so which means we also need to account for that. So which simply means the items which were sold, if the opening and the closing is there, but now there are some items which were sold during the year, which means in the figure of closing, the items which were sold, in the closing value of assets, the figure of items which were sold, it is not there. We're supposed to bring it back. So in our case, our closing was 5679 plus the cost of items which were sold. So the cost of items which were sold were 240,000. Sorry, so 2 plus 240, we have that, which simply means if the items were not sold, the total should have been that. But now since 240 items were sold, that's why I remained with that as the closing. But in the opening, this value was there, so I've added it to the closing. Then we're going to subtract the opening. So the opening in our case, the opening was 4777 477 like that. So which means the value of assets that we purchased were 1142. Since we purchased money went outside, it's an outflow. We'll write it in brackets. 1142. Okay, that's the figure that we need there. Then also we said proceeds from disposal. How much did we dispose them? So they're saying the cost of these assets were 240. If we sold them at a loss of 12, which means, sorry, if we sold them at a loss of 12, we sold them at a loss of 12. They're saying, sorry, the net book value of the equipment when we sold was 96,000. So if the net book value was 96,000 and we sold on a loss, which means the value itself was supposed to be 96, yes, according to the net book value, supposed to be 96, but we sold on a loss, so which means we're going to add the loss on the net book value. So the 96 plus the 12. So the normal price for this was supposed to be, it is 96 plus 96 equipment that had cost the company 240 in February for a loss of 12. Okay, was sold for a loss of 12. The net book value of the equipment when sold was 96. So the net book value itself was 96, but them now they sold on a loss, which means they sold lower than the 96,000. So which means we're supposed to subtract the 96,000, the 12,000 from the 96, which means these people, the value of the equipment at the time they were selling it, the net book value, they're saying it was 96. Them they sold at a loss of 12, which means they're supposed to sell at since the value was 96, them they sold it at 84. That's why they've made the loss of 12. So 96 minus 12, which means these people they sold it at 84. Which that's why there's that loss of 12. If if they sold it at no loss, no profit, it was supposed to be 96,000 because that was the value of the items. But now they sold it at a 4, which means they have that loss of 12. So the proceeds from the disposal was 84 because the value of the net book value was 96. Then they sold at a loss. So this question, you have to be clever. Sometimes they will not tell you the loss, they'll tell you that they sold it at this much, the value was this much, which means you have to assess the situation now. Since they're saying the value was this, then they sold it at this, you're going to think now, is this a loss or profit? That loss, will deal with it on the first part. If there's a profit, still deal with it on the first part. But here we're just interested in how much did they sell it. If they sold it at a loss of this cash, if they sold it at a loss, which means they were supposed to sell at this much, now they sell it at this much. So that's all that we need here. So we have 84 minus 11.11.2 because it's in brackets, 11.11.42. This one is in brackets because we purchased, money went outside. This one proceeds, we sold, cash came in, one that is an inflow. So we have a 1058, which is a bracket, which is a negative. Put it in brackets, 1058. Then from here we go to our financing activities. Under financing activities, we are talking about the things that make up the financed by part. And under financed by part, you know that we have ordinary shares. So for ordinary shares, we know that the opening value of ordinary shares was ordinary shares was 750. At the end it is 650, which means there's an increase of 100. So we sold more shares. We have 100 kwacha, which is an inflow. Then from there we have share premium. Share premium at the start we had share 250, then we have 250, means there's a 200 increase. We sold another couple of shares for 200. Then from there we talk about the long term, the debenture itself, the debenture, or rather the loan. So the loan, they're saying at the start, where is the loan? It was 1000. At the end it is 1, which means there's an increase of 2 as well. So this in total is going to give us a 500. So we have a positive 500 minus 1058 plus 695. So this is where the 137 came from. So that is our cash equivalent. So much that if we add our opening, we are going to arrive at the closing. So our opening was a negative 84. Add opening cash and cash equivalent. Opening cash and cash equivalent was a negative 84. which will be presented by brackets. So the figure that we have, we're going to subtract 84. So we should arrive at the closing. So the closing indeed was a 53, which means everything that we've done is correct. So if we do that, we're arriving at the closing cash equivalent, which is 53. We are done with the second question. So for today we end here. Thank you. So the question is right here. This is 2021 question 4. The question is here. You can screenshot in case you are not able to see clearly. The question is right there and the solutions are right here.